So my name is Dingyue Liu. I'm a PhD student at UC Santa Barbara in economics. I go by Kite, so that's the little kite in the corner. So I want to thank the organizer to include our paper in the program. We're very excited to share this with you guys. So this is a joint work with Nir, who is also a PhD student at UCSB. And we're going to estimate investor preferences for blockchain securities. So let me first give you like a broad overview of one sentence of what we're going to do. So let's say we have traders. They're facing two different blockchain technology. One's vulnerability set is a superset of the other. So one is less secure than the others. So we're interested in how does one perceive this risk, relatively different risk. So let me be a little bit more specific. What do I mean by two technologies? So we have these layer ones. So in this paper specifically, we're going to talk about Ethereum. So these are our main blockchains. We all know it has reached a point that it's facing scalability challenges. So then one solution are come out with these layer twos. Then in this paper, we're going to talk about polygons and also optimisms. So these are all overlaying networks that sits on top of the blockchains. So however, while it's fixed the scalability issues, it introduced potential security vulnerabilities. So this trade-off, and economists love trade-off. This trade-off was brought up by Vitalik when we talked about the blockchain trilemmas. So what the blockchain trilemma is saying that we can't really have high scalability, high decentralization, and high securities. So while Ethereum has very high security and also decentralized, it faces the scalability issues. But then when layer two fixes the scalability issues, it's going to sacrifice some securities. Yes, I see a question.
Arbitrage seems to be larger than optimism.
Yes, I'm going to respond that and then talk about that later. All right. So what's the problem with this? Like when I say L2 is going to sacrifice some securities, can we just directly measure? So measure objective security vulnerability is going to be hard. One of the reasons is it's going to be a very complex problem. So you have to consider the different validation process, the different wrap tokens that is used on these layer twos, and we have to consider these like smart contracts. So it's going to be very complex to objectively measure this relatively securities. And then the other thing is we also couldn't use a frequentist probability approach because we haven't seen any 51% attacks on Ethereum yet, but hopefully no. So we can't really use that. So what about let's say we go to a survey style? Can we survey all the belief from the traders directly? It's not really feasible. One of the reasons is it's going to be hard to identify our users. Like how do you reach all the people? And then you got to be concerned about the quality of the data if you have any surveys. Like we have to design something that is incentive compatible, and then we have to make sure we don't have a selection issues. So our solution to that is we're going to estimate traders' belief on security using real trading data. So the idea is we're going to compare a security concern-free predictions from our model with what people actually do, what we see in the empirical data. And then it's kind of like it's going to review what the subjective beliefs people have in this market. Yes?
Right. What is your definition? It's different.
Right. So I'm not going to go to the actually, why don't we go there? Since you asked, it's not responding. Then it's a PDF, so it's not going to. Okay. So the idea is that we're thinking about what's the chance. Imagine you're doing trades on layer one or layer two on Uniswap. Like, what's the chance you're actually going to lose all your transactions? What's the chance you're going to be attacked? And like the idea is that how safe, how like the subjective beliefs you have relatively on layer one and layer two. But I think if I continue, maybe they'll answer. If not, I will circle back to answer that questions. All right. So let me briefly talk about the literature. So I'm very thankful for all the speakers yesterday and today so that I don't have to talk about DEX and CPMM. And then also the blockchains, there's a literature on the security. What I want to point out is that it's in this econ literature that go back to the 50s when Savage brings up, develop the subjective probabilities that when we that how people's decision making is going to dependent on their subjective beliefs, and how we can use decision makings to back off people's belief, including like Schelling's famous paper on how they induce people's value of life, and then also all the subsequent paper. We're talking about layer 2 solutions, and specifically in inclusion from the L2 solutions, which there are some recent works developed by Will. And then we connect to this real disasters literature. So this is kind of related to the equity premium puzzle. So the idea is that historically we see this shockingly like high returns in the stocks relative to risk-free assets, and traditional econ theory models have a hard time struggle to explain this, and our traditional theory on risk aversion cannot really capture this gap that we see. So one of the explanation is there's rare disasters that people has this fear that there's some rare disasters is going to significantly decrease the value of the stock. That's why people are asking for more returns and compensates for those fear of events. So the idea is that people's these beliefs, people's subjective beliefs, would impact what they are making decisions. So that's how we are going to connect to this literature. Now let me go back to the first slide that I showed you, and then kind of like expand it a little bit. So what we have is traders face 2 blockchain technologies, layer 1 and layer 2, and then layer 2 is less secure than layer 1. How does one perceive this risk? We're going to break down to like 2 different questions to answer. One is how should one decide where to trade if there's no security concerns, if it's a security concern-free environment. And then what we're going to answer is, can we estimate traders' belief comparing our model prediction with the empirical data? Let me walk through the model / structural of what we have. Let's assume that our representative agent is risk neutral and maximize their expected payoff. Traders want to swap, let's say, a fixed amount of token X, delta X for token Y. They're going to face 2 fees in this environment. One is the fixed fee, it's the gas fee that they have to pay. In this environment, the layer 2 will have a much lower gas fee than layer 1. And on the other hand, they will face the variable cost, which in this environment will be the exchange rate, because the liquidity in layer 1 is much more deeper than on layer 2. What that means is that when you're doing a relatively large trade, you're going to get a better price on layer 1. Thus, you're going to benefit from trading on layer 1 instead of layer 2. Then our representative agents would just face this maximization problems, whether or not they should choose to trade on layer 1 or whether or not they should trade on layer 2 based on their utility function, which is going to depend on the fees they're going to pay, and also this pi variable, which is going to be like abstractly capture this security idea. Let me show you some data now, because this is an empirical sessions. So we collect transaction data from 21 liquidity pools on Uniswap protocol, 8 in layer 1, and then 13 on layer 2. A lot of transaction, a lot of data, a lot of money. So let me first back up some of my claims earlier. So earlier I said the transaction, the fixed cost gas fee is going to be lower on layer 2 than layer 1. So this is a time series of gas fees of Ethereum, Optimism, and Polygon. So you can see that Ethereum is much higher than the others. Usually for Polygon, it's like a couple of cents versus on Ethereum, it's $10, $20. Then let me try to make the point that the exchange rate, that the price will be better on layer 1 because they have a much larger liquidity. So here what we have is the time series of pool size. Ethereum, again, much higher than the other liquidity than the layer 2 solutions, which is going to give you a better price when you're doing a swap. All right, so now the interesting things. So I want to first draw you attention to this right portion of the graph. So what this is, on the x-axis is the swapping value, and on the y-axis is the total value that is going to left after you pay the gas fee, after we consider the exchange rate. So this is what we plot is security free one. So on the very right, if you consider you're going to do 1,000K transactions, you are going to want to do it on layer 1 on Ethereum, because your price impact on layer 2 will be too high that you'll be left with significantly less assets after you do it on layer 2. However, if we zoom in off the left part all the way, if you're doing like a $1 transaction, it makes much more sense to do it on layer 2, because you don't want to pay $10 gas fee just to do a $1 transact swap on layer 2, on layer 1. So the slope of the Ethereum is always going to be steeper than the slope of L2. That's why we have a single crossing here. You will find a point that people should be indifference between trading on layer 1 and layer 2, and here specifically is 16K. Yes.
So when you're talking about security, you're talking from the perspective of the sort of like the aggressive incoming trader, right? But wouldn't security be much more of a concern for liquidity providers, because they're the ones who lock their money in long term, and also their decisions are essentially determining where it's best to trade.
Right. So yes. So there. I think it's a very good point, and I think we should also look at how like the liquidity providers are looking at this. But from our in paper that we're going to focus on how like traders are thinking, like how they're making their decisions. All right. So this is just for one day. Yes.
Sorry, what assets are in the pool?
So this is sorry, I did not have it on the. So this is USDC and Ethereum.
Okay, but it's not apples for apples because there's no native Ethereum on the L2s.
Yes, that's correct. So it's the wrap token. We're not considering the wrap yet. So this is just for one day and for one pool. So we do this for. So let me back a little bit. So what we do is that I'm going to show you one pool result, which is the USDC and Ethereum pool pair, and then we're going to expand this to other pools. But this is one day, and then if we do it for 1 year, that is what it looks like. If we consider what people's security concern free switching point, that they will start switching to L1 because it's more monetarily better off for them. And then this is what it looks like. So now we're interested in what people actually do in the actual data, like when do people actually switch? So first, the histogram of the data does tell you most of people on Ethereum trade very large transactions, which is expected. One thing I want to point out is that we cluster everything that is larger than 10K at 10K just to make this graph slightly easier to read. So most of the transactions on layer 2 on Polygon and Optimism are on the far left, that are very small trades compared to layer 1. So what we do is we construct a logistic model. So we are going to model what the probability of of a trade, given the size, it's more likely to be on L1 or L2 from our data set. I'm not going to go into the detail of the regression, but we do find the best threshold for probability, and then we classify all our transactions. So what we have here is the empirical switching point, like where are people actually switch from trading on layer 2 to trading on layer 1, and this is what it looks like. It's not obvious at all, but there's actually a shaded area around this blue line. That is, we do perform bootstraps on these estimations. So that's the 95% confidence in the pool. So now I show you the red line, and then I show you what people actually do. Now let's put them in the same graph, so it's the review moment. So we see, so here for the USDC Ethereum 0.05% pool on Polygon and Ethereum, you see the red line is what our model prediction security concern free, and then the blue one is what people empirically is doing. We see this consistent gap between the two lines. That is meaning that people are like constantly switching earlier to trade on L1, even though that it's going to bear some losses when we think about gas fees and the prices. So this is for one pool. We, as I explained before, we collect 20-something pool, and these are the breakdown of what pool we look at. These are basically our, like the previous talk says, like, you know, the pools that matters. These are like the top pools that we can find on both Ethereum and on Polygon and Optimism. So, and we construct a weighted average for Optimism and for Polygon, what that relative security parameter is going to capture. For optimism, it's about 3.3%, and then for Polygon, it's about 0.7%. We do several robustness checks to see if that gap is due to something else, but not what we claim as securities. So one thing we checked was whether or not the price accuracy is different on Polygon and on Ethereum. So this is the time series of the relative price. Uniswap didn't start support optimism and Polygon until like late 2021. So that's why when you start to see the red line and the yellow line, but they're almost the same. So it's not going to be because of the price difference that is making the gap exist. And also, there might be adoption cost. Maybe people don't have Polygon account. Maybe they have this like bridge fee they have to consider. So what we do is we take a subset of our data that only look at wallets that actually trade on swap on both L1 and L2. And then we specifically look at those subgroup of people and then see what our estimator will be. So for the full data, we got about the mean estimated parameter is about 0.7%. And then for the subset group, we have actually even larger concerns for this relative security. Another potential explanation is that maybe people like to trade on layer 1 because layer 1 has a higher return. That's why we want to keep up my assets in layer 1. So we look at the fee collected per dollar liquidity on these three platforms, and if anything, the Ethereum is even slightly lower than Polygon and Ethereum, Polygon and Optimism. So that's not going to be what the driven force of the gap that we observe. Yes.
Yeah, just what about in preference with layer 1 is the fact that it allows me to more easily exchange to fiat.
Right. So we would so if that's the case, you would so I think what we're trying to do with this fee collected is we're trying to see whether or not people actually have incentives to actually leave more assets on layer 1, whether or not this would capture the preferences for you could be more easily transformed to fiat money. We haven't checked. I cannot, on top of my head, think about any testing that we can do.
I mean, you can look at like centralized exchange transactions, right?
Right. We can compare this to centralized exchange and see. Good point. Thank you. All right. So we've checked these things, and then we found no explanations of these robustness check could actually explain the gap, the consistent gap that we observed. So let me conclude. So what we found is that layer 2 has this impact on DEX inclusions, as we see in that histogram, that we actually observe a lot of like small transaction now on layer 2 solutions. They enable this low stake traders to actually enter the markets. And we found that traders tend to switch to L1 earlier than predicted, which we proposed a model that is going to be the security preferences to explain this gap of the relative security comparing layer 1 and layer 2. And our model suggests that the traders anticipate like 0.7% for Polygon, 3.3% for Optimism. And price accuracy, adoption cost, layer 1 asset advantage are less likely to account for this gap. And our work can be seen as an empirical evidence for the trade-off between scalability, security, and decentralization, which is the blockchain dilemma. Thank you. Just quickly, I want to go back to one of the previous questions talking about Arbitrum. We are looking at it. It's data collection issues that we don't have it included in the current stage of the paper, but we do have preliminary results for Arbitrum 2. Yes. Okay.
So, on the trilemma here,
right.
When people talk about security, they don't often mean like the probability they're going to lose. Right. They mean something like the ability that the layer 2 might be like a denial of service attack or might lose some notion of liveness. And the reason why is because in the layer 2, you always have the ability to go back to Ethereum and claim your assets. So there is kind of no loss in like fundamentally by construction, right? I can always kind of, if something happens in the layer 2, I can always go back and claim my assets in the layer 1. So in that sense, that notion of security is inherited from the Ethereum base chain. So I guess I'm not 100% sure what it is we're measuring here. Like, this is why I'm asking about the definition of security that you're using, because it's definitely different than the trilemma one.
Right. So two aspects. One is it is correct that whatever you can always convert back to Ethereum. That's why we say the vulnerability of Polygon is going to be a subset of whatever vulnerability L1 has. So the second thing I want to make, maybe the word security we're using is we're more thinking about this like rare disaster arguments that we have, is that how people are thinking about this fear of losing their assets. It's the subjective beliefs that people have, not necessarily how maybe in a more computer scientist perspective what the security definition is. But we're more thinking about this rare disaster belief that people hold. That makes sense.
Another thing it's a fancy mic, turbo. Another thing to consider is the bridging risk. So it's not always as easy to go from L2 to L1, like multi chain, they went down. So then a lot of people were out. So that's another perceived risk getting back and forth.
So the L2s, right? Fundamentally, the data is available on the L1. So the bridging risk that you have, I guess, is like, yeah, sure, there could be some like really funky smart contract thing that could happen. But fundamentally, because the data is on the L1, you can always claim it, right? So you can always go back to the L1 and be like, look, like the L2 is not responding. It has not responded for a few blocks. I want my money back, and I'm willing to pay the amount it takes to get it out of that pool.
So I think
so exactly. It's always assuming it's bridged, right?
I think that's a good point in the sense that a following up question or a more next step question will be like, we see people hold this belief. Is that belief correct or not? Whether or not this is exaggerating the concern, or like, does people hold the correct belief? I think that's what we're trying to do next. But right now it's about what they're subjectively.
I think it'd be, just because I think that's the biggest issue with a lot of this, which is what is security here? And, there's logical ways to think about this, which I think could help you explore the issue. Because when I think of it from the consensus perspective. Like, if I'm running an L2 node and an L1 node, my money doesn't go anywhere. It doesn't. So it's difficult for me to like intuit what this is showing. Just on like, if there's a smart contract on Ethereum holding my assets, there's nothing the L2 can do to take my assets. It's just impossible. So like the worst risk is gone. Like, my money can't go anywhere.
Right. So exactly, I think that echoes the point that what we're saying is that people are holding belief. This belief are not necessarily the correct belief. So maybe we understand there's no such risk, but then people are showing this in their decision making. People are showing this belief on the risk, whether or not that's the correct belief or not. I think that's the next step to explore. But what we're trying to show in this paper, it's about the subjective belief. Yes.
Yeah, I will just say as a layperson, and in terms of the blockchain trilemma, when we're talking about security, as a former federal prosecutor, if you're getting to the level that this guy was talking about, your market is screwed. Nobody's going to sit around and talk about layer 1, layer 2 protocols. They want to know, is my money going to get stolen? Is my money get lost? Is there going to be a hack? They're not thinking of it at that level. If you have to get to the security level of that to solve the blockchain trilemma, congratulations, your market's dead. Like, that is never happening. I think what you're talking about is perception of security for a market entrant to get into it. And that person, 99.9% of them, aren't even using the words layer 1 and layer 2. They are figuring out how to go on Uniswap. They are figuring this out. But they're not living in that world. They're living in the world that you're measuring.
Right. That doesn't make sense, though. Then why would they have?
If they don't care, layer 1 is the same as layer 2, then why is any of these beliefs showing up in the data?
Because I think it has to do with how the press reports thefts and hacks and who you perceive to be dangerous versus who you don't perceive to be dangerous.
But I don't see anything like layer 2 being more dangerous than layer 1 in the post. Like,
when was the last time that you heard Ethereum hacked? versus Uniswap or a decentralized protocol being hacked. The perception of DeFi being risky entirely compared to layer one, I think is very different.
But that's the point.
No, I get it. I'm just saying, like, I think what he's measuring is something not computer sciencey and a little bit more basic. And I think you guys are looking at it at a hyper technical level that I just didn't get the impression you were looking at, right?
Thank you. Okay, I think that's it. Thank you.
All right. So